there, and welcome to the Property Wealth Podcast. I'm really excited about today's episode because we're diving into a topic that can truly transform your real estate journey. Scaling with partners through joint venture agreements.
That's right, Sarah. It's a game changer for investors, especially for those looking to grow their portfolio without taking on all the risk themselves.
Exactly. We'll be exploring what joint venture agreements really are, how they can help you leverage resources, and some practical tips on finding the right partners for your investments.
And we'll also touch on some common pitfalls to avoid, so you can make informed decisions and build strong, lasting partnerships.
Plus, we'll share some real-life examples of successful joint ventures, which I think our listeners will find really relatable and inspiring.
Yeah, hearing how others have navigated these waters can really shed light on the potential of working together,
Absolutely. So, if you're over 40 and looking to make a meaningful impact in your investment strategy, stick around, because we have a lot of valuable insights coming your way.
Let's get started. Sarah, when we talk about scaling with partners and joint venture agreements, it really hits home for a lot of folks over 40, especially right now, with everything happening in the economy.
Absolutely, Mike. I think many listeners are feeling the pressure of retirement timelines, right?
Exactly. A lot of people are realizing that they need to ramp up their investment strategies. The clock is ticking, and they want to ensure they have enough saved, especially with inflation making everything more expensive.
Right, and it can be daunting to think about how to build that wealth quickly, but that's where partnerships come in, right?
Yes! By partnering with others, you can leverage not just financial resources, but also knowledge and experience. Think about it. If you're looking to invest in a property that costs, say, $500,000, going in solo can feel overwhelming.
Definitely. But if you find a partner or two, suddenly that burden is shared, and you can make smarter decisions together.
That's the beauty of joint ventures. And look, I've seen people in their 40s and 50s who, after years of saving, realize that traditional methods might not yield the returns they need for retirement.
Yeah, I can imagine that feeling of urgency. There are stories of investors who pooled resources. I know one couple who had been saving diligently, but when they looked at the market trends, they realized their savings alone wouldn't cut it.
Right. So they teamed up with another couple who had a complementary skill set. One couple focused on finding properties while the other handled renovations. Together, they were able to close a deal that none of them could have managed alone.
That's such a smart move. Not only did they secure a property, but they also learned from each other along the way, which is so valuable.
Exactly. And let's not forget about the emotional side of things. Financial security can really impact your peace of mind, especially as you approach retirement.
Oh, for sure. I think many people feel a lot of stress around their financial future. It can be overwhelming to think about what's going to happen in the next 10 years.
That's where having a partner can help alleviate some of that anxiety. You can bounce ideas off each other, share in the risks and rewards, and that can make the investment journey much more enjoyable.
And it's not just about the financial aspect, right? You're building relationships too.
Absolutely. I've seen partnerships blossom into lifelong friendships. It's like having a support system.
That sounds really fulfilling. Plus, with the current economic trends, where inflation is a real concern, investing in real estate can be a hedge against that, right?
Yes. Real estate has historically been a solid investment during inflationary times. Properties tend to appreciate, and rental income can rise with inflation, providing a buffer.
I can see how that makes a lot of sense. Plus, for those who are thinking about wealth transfer to their family, having a solid real estate portfolio can make a big difference in the long run.
Exactly. It's about creating a legacy. I've spoken to investors who, in their 40s, started thinking about how to set their children up for success. And real estate can be a powerful tool for that.
Right. And it's not just about the money. It's about providing stability and opportunities for the next generation.
I was chatting with a gentleman recently who started investing in his late 40s. He was worried about what would happen to his family if anything happened to him. By forming a joint venture with someone he trusted, he felt not only more secure in his investments, but also more confident in his ability to leave something meaningful behind.
That's a great story, Mike. It really highlights the emotional side of financial security, which I think often gets overlooked.
It does. And it's important for our listeners to realize that investing doesn't have to be a solitary journey. There's strength in numbers, and forming a joint venture can open a lot of doors.
So for someone listening who's maybe feeling a bit overwhelmed or unsure about where to start, what would you say to them?
I'd say, start by identifying potential partners. Look for people whose skills complement yours, maybe a friend or colleague who's also interested in investing.
And they don't have to be experts, right? Just someone who shares the same vision and values.
Exactly. Then, have open conversations about goals, expectations, and how you can support each other. That foundation is crucial.
That makes a lot of sense. And once they've established that partnership, what's next?
Well, that's when the real fun begins. They can start scouting properties together, analyzing deals, and figuring out their investment strategy, which leads us to some core strategies they can implement to make the most of their joint ventures.
I can't wait to dive into those strategies. Let's get into the specifics of how they can scale effectively together.
So when you're looking at joint ventures, or JVs, it's super important to set clear expectations from the start. Have an open conversation about each partner's roles and responsibilities.
Right, because if one person thinks they're just putting in money, while the other thinks they're doing all the work, that could lead to some serious tension down the road.
Exactly. A good rule of thumb is to write everything down in the JV agreement. It doesn't have to be overly complicated, but it should cover the basics, like who's in charge of what, how profits are shared, and what happens if things go south.
And what about those practical strategies you mentioned regarding evaluating deals?
Yeah! One of the first things I look at is the 1% rule. It's pretty simple. If the property's price is $200,000, you should aim for a monthly rent of at least $2,000. This gives you a quick way to gauge whether a property might be a good investment.
So if you find a place that's priced at $250,000 but only rents for $1,800 a month, that might not be the best deal?
Yep, that's right. You'd want to dig deeper to see why it's not meeting that 1% benchmark. But, it's just a starting point. There are other factors to consider too.
Like what?
Well, there's the 50% rule. It suggests that about 50% of your rental income will go to operating expenses. So if you're expecting to bring in $2,000 a month, you should budget around $1,000 for things like maintenance, property management, insurance, and taxes.
That makes sense. So if you're looking at a property that rents for $2,000, you're probably aiming for around $1,000 in expenses. And that's before you even think about your mortgage or other costs.
Exactly. And then there's cap rate, which is a way to evaluate the potential return on an investment. It's calculated by dividing the net operating income by the property's current market value. So if your property generates $24,000 a year in income and is worth $300,000, the cap rate would be 8%.
So that's pretty solid, right? If the cap rate is higher than average for that area, it might be a good sign?
Yes, generally speaking, a higher cap rate indicates a better potential return. But, again, you have to consider the market conditions and property type.
And speaking of property types, are there specific ones that work better with JV agreements?
Great question! Multifamily properties can be particularly attractive for joint ventures because they provide multiple income streams. Think about it. If you have a 4-unit building, even if one unit is vacant, you still have income coming in from the other 3.
That's a solid point. So, diversifying income sources can really help mitigate risks.
Exactly. Plus, they tend to appreciate well in good markets. But you also have to consider the financing options available. Have you heard of the BRRRR strategy?
Yeah, I have. Buy, rehab, rent, refinance, repeat, right?
You got it. It's a fantastic way to scale your portfolio. Essentially, you buy a distressed property, fix it up, and then rent it out. Once you've increased its value, you can refinance to pull out some cash and use it for the next property.
That sounds like a smart way to leverage your initial investment. But what about the financing part?
Well, when you're in a JV, it's crucial to have a clear agreement on how financing will be handled. Are both partners contributing equally? Or will one partner take on the mortgage while the other covers renovations?
It's all about clarity, right?
Yes, and don't forget about the exit strategy. It's essential to have an understanding of how you'll handle the property down the line. Are you planning to sell after a certain number of years, or will you keep it for cash flow?
Those are big questions. So it's not just about finding the right deal, but also about aligning your long-term goals with your partners.
Absolutely. And while we're on that subject, it's important to establish a communication plan. Regular check-ins can help keep everyone on the same page and avoid misunderstandings.
I can see how that's critical. If you're not communicating, even the best plans can fall apart.
Right! And let's not forget about having a solid exit plan in case one partner wants out. It's not fun to think about, but it's better to have those discussions up front.
That makes total sense. So, what are some common pitfalls to watch out for when entering into a JV agreement?
Well, one major pitfall is not doing your due diligence on your partner. You want to know their financial background, investing experience, and work ethic. You don't want to get into a partnership with someone who doesn't share your values or goals.
Yeah, that could lead to some real issues down the line.
Another one is neglecting the legal aspects. You really should have a lawyer review your JV agreement to make sure everything's covered properly.
Those are some valuable tips, Mike. It sounds like with the right strategies and communication, JVs can be a powerful way to build wealth.
Definitely. Just remember, it's about teamwork, trust, and having a plan in place.
Well said. We'll dive deeper into those pitfalls next, so stick around.
So, Sarah, when we talk about scaling with partners and joint venture agreements, one of the really common pitfalls I see, especially with newer investors, is over-leveraging. You know, they get caught up in the excitement of a potential deal, and they end up stretching themselves too thin financially.
Yeah, I can see how that would happen. They might think, oh, I've got this great opportunity, and if I just take on a bit more debt, everything will work out. But then if the market shifts or something goes wrong.
Exactly. I once worked with a couple who had this amazing vision for a multifamily property. They had partners lined up, and they were ready to jump in. But they were so focused on the potential cash flow that they didn't consider how much they were borrowing. When the market cooled a bit, their rental income didn't cover the mortgage payments, and they found themselves in a tough spot.
That sounds really stressful. What did they do?
Well, they ended up having to sell the property at a loss. It was a hard lesson, but it taught them about the importance of understanding your financial limits and ensuring that your cash flow can comfortably cover your expenses, even in less than ideal market conditions.
Right, and I guess that ties into another mistake, not taking cash flow seriously enough. It's easy to get caught up in the potential appreciation of a property, but if the cash flow isn't there.
Absolutely. I've seen some investors ignore cash flow projections entirely, thinking, oh, it'll appreciate, it'll be fine. But when they have bad tenants or unexpected repairs, they realize too late that they can't pay the bills.
Bad tenants can really be a nightmare, can't they? I mean, what's the worst situation you've come across?
Well, there was this one case where a friend of mine got involved with a property that had tenants who seemed great at first. They passed all the checks, but once they moved in, it turned into chaos. They were constantly late on rent, and then there were complaints from neighbors about noise, and it just spiraled from there.
Oh no! Did he have any recourse?
Not really. He had to go through the eviction process, which took time and money, and during that time he was missing out on rent, and the property was deteriorating. It was a tough lesson about, the importance of thorough tenant screening and having a solid lease agreement in place.
And I imagine that's something that can be hard to bounce back from, especially if you're counting on that rental income to help pay the mortgage.
Exactly, and that's why I always recommend having a buffer in your budget for unexpected costs, like repairs or vacancies. Another common mistake is ignoring those hidden costs, like maintenance and property management fees.
Oh, definitely. I think some investors underestimate those expenses.
Yeah, I had another client who bought a property thinking it was a steal, but they didn't factor in the age of the roof, the plumbing issues, and, even landscaping upkeep. They ended up spending way more than they anticipated just to keep the property in shape.
That sounds frustrating. So how can someone spot those hidden costs early on?
Well, first off, do a thorough inspection before you buy. And I mean really dive deep. Get a good inspector who knows the ins and outs. You want to identify potential problems before they become financial headaches. Ask for maintenance records, too. If a property has a history of constant repairs, that can be a red flag.
That makes a lot of sense. And then there's the issue of timing the market, right? Some investors think they can predict the best time to buy or sell.
Oh yes, that's a classic pitfall. I've seen investors wait on the sidelines for the perfect moment to jump in, only to miss out on great opportunities, or worse, to panic sell when the market dips.
Exactly. I imagine that kind of volatility can really mess with your long-term strategy.
For sure, I had a colleague who kept waiting for the market to drop before he bought a rental property. He thought he was being smart by holding out for a better deal, but prices kept going up, and he ended up paying way more than he would have if he'd just bought when he first started looking.
Wow, that's a good point. So what's the best approach to avoid those timing mistakes?
Focus on your investment strategy rather than trying to time the market. Look for properties that fit your cash flow needs and long-term goals. And remember, real estate is typically a long game. You want to buy at a price that makes sense for your financial situation, regardless of short-term market fluctuations.
That's a great mindset to have. So if someone finds themselves in one of these pitfalls, like over-leveraging or bad tenants, what can they do to recover?
Well, first, it's important to assess the situation honestly. Understand where you stand financially and what your options are. If you're over-leveraged, you might need to consider restructuring your debt or even selling off a property to regain some financial stability.
And for bad tenants?
For that, it's crucial to act quickly. Start the eviction process if needed, but also take the time to learn from the experience. Review your tenant screening process and make necessary adjustments. It's about being proactive and learning from the past.
So, the key takeaway is to be diligent and do your homework up front. And if things go sideways, there are always ways to pivot and recover.
Exactly. Real estate investing is all about learning and adapting. By being aware of these potential pitfalls and acting wisely, you can set yourself up for long-term success.
Well said. So what's next on our agenda?
So now that we've explored joint ventures, let's talk about some immediate steps people can take to start implementing this strategy.
Yeah, absolutely. One of the first things I'd recommend is to, really assess your network. Start by thinking about who in your circle might be interested in real estate investing. It could be friends, family, or even colleagues. Just make a list.
That's a great point. And once you have that list, maybe reach out for a casual chat. You don't need to pitch them on a deal right away. Just discuss your interest in real estate. You'd be surprised how many people might be on the same page.
Right? And then, if you feel comfortable, you could suggest attending a local real estate meetup. It's a fantastic way to meet like-minded individuals and potential partners. Websites like meetup.com or even Facebook groups can be excellent resources for finding these events.
Exactly. And while you're networking, it might be helpful to familiarize yourself with some tools and apps that can assist you in the investment process. For instance, have you heard of Zillow?
Oh, definitely. Zillow is great for accessing property listings and getting a feel for the market. You can see what similar properties are renting or selling for.
Right. And then there's the Bigger Pockets calculator. It's super useful for analyzing potential deals. You can input your numbers and see if a property meets your investment criteria.
Yeah, and speaking of analyzing deals, have you tried Deal Check? It's user-friendly and allows you to evaluate properties quickly. You can even share your analysis with potential partners, which is really helpful.
And don't forget Rentometer. It's a great tool for checking rental prices in your target area. Helps you gauge what you can charge if you decide to rent out a property.
Absolutely. And if you have access to a local MLS, that's a goldmine for real estate data. It gives you a deeper insight into properties, market trends, and even historical data.
For sure. And as you're getting comfortable with these tools, I'd suggest starting a habit of analyzing at least one deal per week. It doesn't have to be complicated.
Yeah, just pick a property, run the numbers, maybe even role-play discussing it with a potential partner. It builds confidence and helps you get familiar with the process.
That's a great practice. Also, consider diving into some books or podcasts that focus on joint ventures and real estate investing. A couple of books I'd recommend are the book on rental property investing by Brandon Turner and Real Estate Investing for Dummies by Eric Tyson.
Those are solid recommendations. And podcasts like Bigger Pockets podcast are super helpful. You can learn from other investors' experiences.
Right, they share real-life stories and tips that can inspire you as you start your journey. And don't forget to engage with the community. Whether it's through comments, forums, or social media, it's nice to connect with others.
Yes. And, if you're feeling a bit overwhelmed, just start small. Maybe join a local real estate investment group. It's a great way to meet people and share experiences.
Exactly. And remember, it's all about taking those small, consistent steps. You don't need to jump in with both feet right away.
Yeah, just start where you are. If you can analyze one deal a week or attend one meetup a month, that's progress.
And as you build your knowledge and network, you'll naturally start to feel more comfortable approaching potential partners for joint ventures.
Definitely. And as you do this, keep a journal of your thoughts, insights, and even questions you have. It helps you track your progress and reflect on what you're learning.
That's a brilliant idea. It's all part of the journey, right? And when you find someone who shares your vision, you can start discussing how to structure a joint venture.
Exactly. And when you're ready, having a clear understanding of a JV agreement is crucial. So make sure to do your homework on that front too.
For sure. And consider consulting with a real estate attorney to ensure you're covering all your bases. It's worth the investment to protect yourself and your partners.
Yes. And with all these tools and steps in your pocket, you'll be well on your way to scaling up your investments through joint ventures.
So those are some practical first steps. Now let's bring this all together. Well, Sarah, that was quite a deep dive into joint venture agreements, wasn't it?
Absolutely, Mike. I think we really unpacked some essential points. One major takeaway is the importance of clarity in your agreement, right? Setting out roles and responsibilities clearly can really save you a lot of headaches later on.
Exactly. And another key point we discussed was the need for alignment of goals, whether it's financial targets or timelines. If everyone's not on the same page, it can lead to some serious conflicts down the road.
For sure. And we can't forget about the importance of trust and communication. Those two elements are foundational for any successful partnership, especially in real estate.
Right. And then there's the financial structure of the deal. Understanding how profits and expenses will be shared is crucial. It's all about being transparent from the start.
Yeah, and I think that really ties into the overarching theme of building wealth through real estate. It's not just about property management. It's about creating strong, supportive networks.
Absolutely. Real estate doesn't have to be a solo journey. With the right partners, you can leverage each other's strengths and resources, which can significantly accelerate your wealth-building journey.
So, if you enjoyed today's discussion, we'd love for you to like this episode, subscribe to our channel, and maybe even share your biggest takeaway or a question in the comments.
And don't forget to share it with someone over 40 who's thinking about investing in property. It could make a real difference for them.
Next time, we'll be diving into real estate funds, specifically the basics of LP investing. It's going to be another enlightening discussion.
Definitely something you don't want to miss.
Thanks for joining us today.
Take care, everyone.
Until next time.